Today, in our Spotlight series, we're answering your question of the month, and I've asked iCapital Private Wealth Solutions Managing Director, Nick Parcharidis, to lend his expertise. Nick, thanks so much for joining us in the studio today.
Anastasia, thanks for having me.
It's great to be here. We have the right question for you. I know it's right on your wheelhouse. And here's the question. How does defined outcome investing enhance diversification beyond the traditional 60/40 portfolio? And what are some of the latest innovations in DOI, and how are they expanding some of the choices for advisors and their clients?
Well, I think first of all, let's level set the definition of what defined outcome investing is. Most people know defined outcome investing as historically being available through, say, structured notes and annuities, because these are passive investment strategies that deliver a defined outcome over a stated period. They basically allow clients to be able to enhance income or gain equity exposures while minimizing their downside risk. What we've really seen, though, is a lot of innovation recently where you're getting many of the same benefits, but through a fund. Fund characteristics such as liquidity, for instance, and access to greater strategies. So those innovations have really expanded the universe of clients beyond just mass affluent, high net worth, to include also ultra high net worth clients.
The access has been expanded such that some of these defined outcome strategies have really come more into vogue in the last 5 years, to the point where there was a recent Wall Street Journal article saying that these have become boomer candy for retirees. So why do you think we've seen that growth? Why do you think we've seen that surge in popularity?
Yeah, so I probably fall into that category of boomer. But I think what's really driving it is a couple things. First off, market conditions, right? Clients are seeing better terms to meet their investment objectives. We're in a relatively high rate environment. Volatility spikes. That translates into better terms for clients. They have greater access to different vehicles to purchase these, such as funds. Clients tend to be very comfortable with funds. Also, given their time horizons, it allows them to purchase and liquidate whenever they need to. So it aligns with their market view and their time horizons.
So why are funds potentially a better way to go?
Number one is because more investors can access those funds, right? Traditionally, derivatives, you needed options-approved accounts. But for most investors, that's not an option, right? The daily liquidity feature allows them to buy when they need to and liquidate when they need to. So they can do that in addition to track their investments and their daily mark-to-market pricing, which is important as well.
Right. So there has been this surge in popularity, and advisors must be incorporating this as part of the strategic allocations within their portfolios. Or how would you advise that advisors do just that?
It's become much more mainstream and part of their core holdings. It's really becoming an extension of their equity allocation, as well as an extension of their bond allocation as a way to enhance income without taking stock risk. And they're doing that primarily in the public market alternative bucket, right? And so because they're readily available, they can add or redeem when they need to, whether it's in a fee-based account or a model portfolio, given those specific characteristics.
And so there's a strategic allocation consideration, but there's also, I'm sure, tactical opportunities. Where are some of the tactical opportunities you see today with these defined outcome strategies?
Yeah, so what we're seeing is more thematic sectors such as small cap US, semiconductors. Earlier in the year, we saw a broadening out of equity participation in the so-called catch-up trade.
Yeah.
And so for a lot of investors, rather than just go long small caps, they deemed going long small caps in a risk-controlled way a much better option. Same with semis. When valuations reset, they were looking at semis and thinking, okay, valuations at these levels may still be high, but I can access it again in a risk-controlled way. All these means allow them to better diversify. So when we do have potential market sell-offs or corrections, what it allows is more stability in that part of the portfolio, just giving the protection that they have. And the fact that they can liquidate gives them the ability to pivot when they need to, and then after the correction, go along some other sector.
This year has been a good example of how some of that came in handy, because I remember talking about semiconductors back in April, and look, we've liked the trade a lot from a secular perspective, but from a near-term perspective, what you notice is the valuations were quite high, and so the risk for a drawdown was building, especially given how well the semiconductors have performed. So that was sort of a perfect time to think about having a defined outcome and maybe some protection on the downside while still retaining the upside.
Well, especially given the volatility we see in the sector. I mean, how great is it that you can get upside in semis right, over a short period of time, a little bit over a year, that can potentially earn double-digit returns while at the same time having a nice buffer or level of protection should markets correct at any particular time.
Where do we go from here with defined outcome strategies?
Yeah, I think we're going to continue to see significant growth, not only in these new funds that are available, such as ETFs and unit investment trusts, but we've seen record numbers in structured products and the ways they're being used, both tactically and strategically. That market has exceeded about $150 billion here in the U.S., and we're seeing the same thing in the annuity market. I think all of these solutions play well into the upward trend in fee-based advisory accounts, model portfolios, and so we're just going to continue to see greater utilization by advisors on behalf of their clients.
Right. Nick, thanks so much for helping us understand the defined outcome investing today, what's driving it, and what's ahead. Thanks so much for sharing your expertise.
Anastasia, always a pleasure. Thanks for having me.
Great to see you. And we'd like to hear from you. Send us an email at yourquestion@iCapitalNetwork.com and let us know what questions are the top of mind for you and your clients. I'm Anastasia Amoroso, and thank you for joining us today. We'll see you next time on Beyond 60/40.